Morning. So the Fed's come out, and that was fun. A bit to unpack, to be honest. So Fed's come out, and later on we will get, Yellen speaking in the press conference. That's the most important bit. But they did raise rates in the US by 25 basis points, and market indicates that that's where it's going to stop. The next meeting, which is in May the 2nd. Is now less than 50% chance of a rate hike. So it seems that the market thinks that this is where it's going to stop. ECB don't meet today, but a lot of their guys was saying that they've beaten inflation, and the rates aren't going to raise any more over there as well. Later tonight we will get Swiss National Bank, which is important because of the Credit Suisse and UBS situation, and then we'll get the POMs out of the UK. Just a couple of headlines I want to go through. So the Fed raises rates by 1/4 point. It says the banking system is sound, and here you can see that ECB is vindicated on their raising of rates, and that inflation is now starting to be curtailed. Plunging markets would suggest that they realise that the soft landing is on life support, that they're not going to get a soft landing, right? But let's go through Tyler Durden's take on it. Generally a reasonable take. So the stock market was FOMC statement. They raised rates, the stock market rallied, faded off it. Then Powell said we consider the pause, but then decided to raise rates, and so that was bullish, the fact that we consider the pause. And then Yellen spoke, and it all turned to rubbish. So that's the stock market. I guess the most important thing here is that members recognise the impact of the financial system crisis on a credit tightening, which is doing the same job as raising rates. And what that is, so he's basically saying that the banking crisis is compounding or tightening credit between banks, which is in the same effect as raising interest rates. So therefore, why will they need to raise interest rates? Now, Yellen, when she came out and spoke, and we'll talk about that in a second, it's effectively, I guess, validating this comment in that the credit tightening will have the same rates. Now, what Yellen came out and said was that they're not going to be supporting unilaterally supporting the not supporting the banks, right? So not considering a broad increase in the deposit insurance. So that would suggest that the credit market is going to tighten further, yeah, and therefore interest rates have reached a peak. Now, this is a double-edged sword. Interest rates reaching a peak would be good for stocks and bad for bonds, yeah. But the other downside of it is that it also means that there's, as the AFR suggested, is that there's no soft landing coming. It's going to hurt, and there's more pain to come, and we can see that in the price action of stocks. Like regional banks took a hit, lots of office real estate took a hit. Bonds came off as well, and money flowed to the euro and the yen, but more so the yen, because if you go and have a look at euro dollar outweighed all its majors. You can see here euro completely blitzed the day, beating everybody except the yen. So the yen was the big winner of all of this, with, well, I guess the Bank of Japan don't think it's a winner, but that's where the money flowed into the yen and to the euro, but more so the yen. So looking forward, where do we go from here? Well, that's a tough one. Right? Here you can see the stock market's just got smashed into the close. As you can see, the stock's got absolutely blitzed, and rightly so. I think the stock market's more downside to come. But where are the interest rates going? That's a tough one. It would seem that interest rates aren't going anywhere now. Is that they're going to be up at 5% for the remainder of this year. Fed said they're not looking to lower rates, not even considering it. It's not even in their base case, to quote. But if the market does continue to tank and they hit a recession, then interest rates would potentially come down at the end of the year, maybe even sooner. Where's that go for the dollar? Yeah, that's the hard one. That's one I'm struggling to try and follow. Is why would the US dollar be getting sold off? Mainly because people don't want US assets. If interest rates aren't going up, then why buy US treasuries? If the banking crisis escalates into a full-blown recession, why own US assets? And that's, I guess, the base case for the US dollar. And where to from now? I'd say it's probably back into a downtrend. It's certainly, if we're looking at the shorter time frames, that's where it's going. And if that's the case, then you have to be looking at euro and you have to be looking at yen as the stronger currencies to trade against weaker currencies, which to me are not the Aussie, because you can have a look at commodities. Commodities are all a little weaker, except for gold, obviously. So to me, it's a you're looking for the stronger currencies such as yen and maybe euro, and buying those for against a weaker currency. So I guess time will tell, but a fair bit to sort of try and get your head around at the moment, I guess. But we'll work on that and we'll come back tomorrow. Cheers.